Hello everyone. In this video, we're going to be going over preparing a cash budget with our question number 5 in our chapter 7 end of practice exercises. So in this exercise, we have Faro Company that expects to have a cash balance, and this is as of January 1st of 2017. So what we want to do is prepare our cash budget for the 2 months of January 2017 and February of 2017. So this is going to be monthly budgeted data. So this is not based on actual results, but it's based on past information to assist us in planning for the future. So budgeting is a very important aspect for businesses. You're going to be learning a lot more about budgeting in managerial accounting. So we're going to start off with our cash budget. And our cash budget, we always start off with our beginning cash balance. And you'll notice that we're given the cash balance for January at the beginning of the month, but we're not given any information for February. And the reason why that is because our ending cash balance that is budgeted for the end of January is going to be the beginning of February. So one period's ending is the next period's beginning for cash, okay? So then we want to think about, well, what are the things that are going to increase our cash balance during the period? So when we look at things such as collections from customers, that is going to increase our cash balance. So first we start off with our beginning cash balance. So we're given the amount for January. Then we're going to add our cash receipts. And one of our cash receipts is going to be our collections from customers. So that's the first thing that you want to include in your problem right here. Okay, so we're going to include the collections from customers, and these are going to be a cash receipt. And you're given the budgeted amount for both years. So you can see that January's budget is less than February, and that could be for a number of reasons. Maybe you've already collected most of the outstanding cash receipts before January started from the prior months. Maybe January is a month that has a large volume of sales, and you're going to be collecting the cash the next month. So there could be a number of business reasons why you might have a different budget from one month to another month. Then we have our payments to suppliers. So anytime you see the word payment, that means that it's not going to be a cash receipt. That's going to be a cash disbursement, which means that your cash is going to be reduced. Okay. Kind of the same thing with our wages, right? These are going to be also payments, okay, that are going out to your employees. Then we have administrative expenses. Those are also things that we're going to be paying out to our employees. And then we have our selling expenses. Those are also going out to our employees, or not just our employees, but just regular selling expenses such as your advertising and things like that, okay? So the amount to the employees actually got included in our wages. And then we have our sales of short-term investments, okay? So investments are part of our investing activities. We're expected to receive cash. So this is going to be a cash receipt. So we're going to read about this a little bit more, and because this is a cash receipt, you're going to include the sale of short-term investments into one of your cash receipts boxes, right? So the sales of short-term investments in January are expected to realize $12,830 in cash. Faro Company has a line of credit at a local bank that enables it to borrow $25,000. The company wants to maintain a minimum monthly cash balance of $32,600. So basically in this problem, they gave you a lot of extra information. The only piece that you need to pay attention to here is the sales of the short-term investments held at the bank and the cash that's expected to come in. The line of credit is kind of like when a company has an arrangement with a bank where they can borrow money and they'll pay it back. And this is like kind of like the dollar amount that they can borrow up until. It's like $25,000. So it's kind of like having a credit card where you have like a credit limit and you can make some purchases, right, on credit, but then you have to pay it back and you can only borrow up to a particular dollar amount. Also, the company's desire to maintain a minimum monthly cash balance is, well, if you look at their cash in their bank, they want to make sure that they always have the minimum of $32,600. And if they don't have that minimum of $32,600, that means that they need to maybe take out a loan in order to maintain that balance to be a minimum of $32,600. So we're going to go ahead and move to the next part of this problem. So we have our beginning cash balance. We're going to add our cash receipts, which include collections from customers, sale of short-term investments to get us our total cash receipts. You'll notice that the only missing piece that you have here is our February beginning cash balance, because you're going to get that from January's ending. So the next part of this reconciliation entails coming up with the total available cash, which will be the beginning cash balance plus the total receipts. That'll give you your total available cash. And then you're going to be subtracting out all these disbursements. And in the first part of our problem, you can go back to the beginning of the video where I had specified which ones were going to be cash disbursements, which means payments that we expect to have. We expect to have payments to suppliers, wages, administrative expenses, selling expenses, and with all of these, we're going to total our disbursements. So you'll want to include the information from our problem. And I'm just going to put in some side calculations, right? For our total available cash, we take our beginning cash balance plus the total receipts. Then for our excess or our deficiency, right, of the total cash balance over the disbursements, we're going to be taking our total available cash minus the total disbursements. So we want to see how much cash do we still have left over after we make those payments. And this is where we want to make sure that we have that minimum cash balance that was described earlier in our problem. We want to make sure that we have that minimum balance amount. So in this problem, we saw that the minimum cash balance was $32,600. That's the minimum amount that we want to have. So just keep that in mind. And the next thing that we want to do is figure out, okay, well, do we need to have any other financing? Okay, so in this problem, they didn't specify any more borrowings that we needed, but if this amount was less than the minimum, we might need to make a borrowing in order to equal to the minimum. We didn't note anything relating to repayments, so our ending cash balance is $34,940. We're going to use this amount. Remember how 1 year's ending is the next year's beginning. So we're going to use this for our beginning of February. We're going to add in our cash receipts. All this information was just data in the problem. We're going to subtract out the cash disbursements. All of this information was from the problem. And we're going to compute the excess or the deficiency of the available cash over the disbursements. So we're going to be computing this dollar amount right here. So once again, this is going to take the total available cash, subtracting out all those total disbursements that we're budgeting for. And once we've done that, we're going to realize that this does not meet our minimum. So I'm going to scroll up, and you'll want to remember that our minimum is $32,600. So this is less than the minimum cash balance of $32,600. So if our minimum is $32,600, we have to figure out, well, how much more do we need to borrow in order to come up with that dollar amount? So we're going to take $32,600 minus the excess that we have, so the $20,450, and that's how we're going to come up with the amount we need to borrow, $12,150. So this is the amount that we need to borrow in order to end up with this minimum cash balance of $32,600. So thank you for taking the time to watch this video.